What's up, everybody? We got some big updates from the IRS guidance on the new tax bill that President Trump signed into law back on July 4th. I'm going to run over these major categories so you can see these. Got some other videos to break these things out even further. But right now, I'm going to hit the highlights of everything so you can see this. I know your time is valuable, so let's get into this. So let's get into the one big beautiful bill summary. So we take a look at this. First thing, things that have not changed on here. Capital gain taxes remain the same. I'm going to hit that in just a second. Individual income tax rates stay the same. 1099 qualified business income tax deduction stays the same at 20%. That's for small business owners. Net income, say 200,000, 100,000, you take 20% off of that right away. That stays there. They thought that was going away. There's a state and local tax workaround known as a pass-through entity for states. They kept that in place. But they did change the state and local income tax deduction ability, and I'll talk about that in a second. 1031 exchanges for real estate type investments. A lot of people made a lot of money in real estate when the rates were so low, and then all of a sudden everything got driven up with COVID and stuff like that. You can have a couple $100,000 gain or $300,000 gain on a property, and you switch that to another property on a like kind of exchange that qualifies, pay no income or capital gains tax on that. That's staying around. They thought that might go away. Entertainment expenses still not available to deduct. Those stay the same, but your meals and dining for business purposes, that's still out there. I believe that's 50%. Net investment income tax stays the same at 3.8%. This is for people earning over $200,000. As you can see here, single $250,000, joint, I think it's $125,000 for filing separately. Anything over $15,200. You have net investment income such as dividends, interest, royalties, S corporation businesses. You get hit with this extra 3.8% tax on that if you don't do proper planning. That's staying there. Corporate income tax is at 21%, staying the same. So let's hit a quick look at the tax brackets I mentioned. 10, 12. I'll blow this up a little bit so you can see it. So 10, 12, 22, 24, 32, 35, 37, all staying the same. That was supposed to go up, guys. Everybody's talking about, oh, there's nothing in this for lower end income versus higher income. These were all going up. So everybody's not going to get their taxes increased here on that. We got inflation adjustments on the top end, like filing jointly now at 12%. It's at 96,000 before we jump into the 22 and 24. That's the big leap. 12 to 22 to 24, we're taking a big leap there. And then you go to 32 and 35. So we'll move on from that. The next thing we're looking at is the capital gain taxes stay the same, 0, 15, and 20, depending on where your income. I'm going to do a video on this, but capital gain taxes, they stack on top of your other income. This is the huge, big adjustment. I did a video on this talking about how somebody now age 65 and older, you're making over $100,000 of income filing jointly, how you can literally pay zero tax on your Social Security and your other income. I do a video on that. You got to check it out. But basically, this is everybody's getting an increase on their standard deduction across the board, no matter how old you are. $15,750 single, joint $31,500. Then you got a $6,000 additional on top of that for the seniors if you're hitting 65 by the end of this year. So as long as you're turning 65 by the end of this year, you're getting an extra $6,000 on top of that. It does phase out. So if you have income, your modified adjusted income greater than 75,000 single or 150 joint, that does phase out. You got to look on page 1 of your 1040. So here's where you're going to look for your adjusted gross income. Our clients can see this, and this is on your tax return, but we actually give them access to the #1 ranked financial planning software in the country. And if you look right down here in this corner, you'll probably see all the detail of how that became the #1 ranked planning software in the country, financial planning wise. But we give them on their tax section of this software up here in the upper right corner, we run these simulated 1040s. And you can look at different years. You'll automatically click a button. You can look forward next year, the following year, what your taxes might look like based on certain adjustments we might make for them. But where you want to look for your adjusted gross income is right here. It is on line 11, right here, adjusted gross income. So this is before your standard deduction or itemized deduction. And there's going to be deductions that come off your Schedule 1, like health savings account, IRA deductions, business deductions will come off of this. But come to line 11 on your 1040 to see, get an idea where your adjusted gross income is going to be, to see if these things are going to work out. And of course, things change during the year, if your income is going to change and all that. There's a link in the description of the video where you can click on send us an email, and we'll actually send you a link and get access to this and play around with it. See what you think. And if you want us to do a consult with you and talk, we can talk about that too. So anyway, back here I was talking about everybody gets an increase in their standard deduction, but the seniors age 65 and older get this extra bonus of $6,000 each. So actually, if you're single, your standard deduction is $15,750. Plus you already get this extra $2,000 that's already been on there. So for seniors 65 and older, so your standard deduction is going all the way to $23,750 as a single person. Joint, it's going up to $31,500. Plus you each get, as filing jointly, you each get $1,600 a piece. So that's $3,200 plus the $6,000 each. So you're literally getting a $46,700 deduction, married filing jointly. And when you start running these calculations, and take a look at my other video about this, literally making over 100K and you're paying essentially zero tax on your Social Security and your other income. Now there's circumstances that can change and all that. President Trump campaigned no tax on Social Security. He's getting there virtually with this, with a majority of all the seniors out there with their income. But take a look at that. All right, next one we look on to. Income from overtime. Let me blow this up a little bit so you can see this. $12,500 single, up to $25,000 joint, no tax on overtime. I'm not going to go through all this, be like time and a half and all that as far as what applies. But bottom line is, for that, you're getting those type of deductions. You do phase out. Also here, $150,000 single, $300,000 joint, unavailable as you get to those higher levels up there on that. Now, they say no tax on overtime. However, you still have to pay Social Security tax. You still have to pay 6.2% Social Security tax plus 1.45% Medicare tax. And then if your income is over $200,000 single or $250,000, then you're starting to pay this extra Medicare tax of 0.9% on that. So there's some other things that might come out on that, but that's the most recent update, that it's going to be on pay and a half, anything over that on their half portion. And that'll be out there, and it gives more indications on that. Okay, next we're going to get into no tax on tips. They're giving you up to $25,000 no tax on tips, which is fantastic for a lot of people, especially in the restaurant industry, salons, taxis, Ubers, that type of thing. Whether you itemize or not. This goes also back to the no tax on overtime. I want to make sure I'm clear on that too, that whether you itemize deductions or not, or don't itemize, so if you just take the standard deduction, which I showed you before, you get this on top of that where you're not having to pay that. So it's another $25,000 exclusion from your income on tips and stuff like that. So it's any tips received after December 31st, 2024. Applies to cash, non-cash tips reported to employees. So these are the updates from the IRS on this. The income cap, again, have another threshold, have another phase out, 150 single, 300,000 joints. The one on the overtime. Tips above those thresholds remain taxable, as it says. And again, you still have to pay the FICA tax that we just talked about. Employees must report the tips to employers on a Form 4070. And employers allocate tips for large food, beverage establishments. Ensures tips count towards Social Security and Medicare benefits on your tips. Because as you get older, then that's counting towards your income, that counts towards calculating what your Social Security benefit's going to be. So by paying that on there, that's what you're going to get, but you still have to pay it on that. You just don't have to pay the federal up to those limits. And if you meet the standard or the phase out limitations, you're underneath those and everything. Here's some information on the income from tips continued. I'm not going to go over all that right now, but they're going to establish more guidance. By October 2nd is the requirement to come out, so we'll keep you up to date on that. Auto loan interest deduction. This is another nice one for folks. If you're under $100,000 adjusted gross income, remember that adjusted gross income, line 11 on your tax return. Under $100,000 single, $200,000 joint filers. Again, this is above the line deduction. It has nothing to do with your standard deductions, itemizing, whatever. This is on top of that. You go out and buy a $50,000 car, you got a 5%, $2,500. That is a deduction of interest for each year that you can take. And as your interest will go down as the loan gets older, but that up front. So make sure you look at that. The maximum annual deduction is $10,000. Phases out like I talked about. Qualified interest must be paid on the loan that is originated after December 31st, 2024. Used to purchase a vehicle originally used by the taxpayer. Used vehicles do not apply. So that's a big update. You cannot use it on a used vehicle for that. Personal use vehicle only. You can't do it for business. It has to be secured by a lien on the vehicle. If the qualifying vehicle loan is later refinanced and interest paid on the refinanced amount, it's generally eligible for the deduction. So that's still good. And then if we look at further information on qualified vehicle, a qualified vehicle is a car, minivan, SUV, pickup truck, or motorcycle with a gross vehicle rating of less than 14,000 pounds. It has to be finished, the final assembly, in the United States. So that's the big deal on it. And you can determine if your vehicle is eligible for this. Usually there's going to be information label attached to the vehicle on the dealer's premises. You can check the VIN number and you go to this website here, the VIN decoder. It's National Highway Traffic Safety Administration. And then the deduction is available for both itemizing and non-itemizing, which I mentioned before. And you got to include the VIN number on your tax return. As far as reporting wise, they're saying that lenders or other recipients of qualified interest with the IRS and furnish statements to taxpayers showing the total amount of interest received during the taxable year. So there's going to be more guidance coming out on that. Mortgage interest deduction still up to $750,000 acquisition limit made permanent. That includes the mortgage insurance premiums. I think that's different now. There is no AGI phase out that we saw. State and local taxes. This is the other big one I mentioned. Now up to $40,000 from $10,000. So some of you that have the bigger mortgages, bigger state taxes, this could be a benefit to you. Now there is a phase out on this too. If you go over $500,000, you start phasing out, it completely phase out $600,000, and you'd be coming back to the cap of $10,000. So keep that in mind. There is that workaround where small businesses can actually pay these taxes out of their business account to the states, and that helps them get around this $40,000 limit. So that's one thing to be aware of. Talk to your advisor on this. And by the way, I'm a certified financial planner practitioner, been doing this for over 30 years. I'm a certified tax planner, but not a CPA. So make sure you're double checking with your CPA on everything that I'm talking about. Child tax credit, that's made permanent up to $2,200 from $2,000. You actually can go get a $1,700 refund, meaning if this credit drives you into a negative situation where you're basically supposed to get back $1,700 when you were going to maybe get zero back, you still will get that. So it's a credit, not a deduction, but an actual tax credit, dollar for dollar on there. It does have a phase out of $200,000 single, $400,000 joint on that. Education accounts, no phase out on AGI, but the big thing here is they updated the homeschooling and credentialing. If you want to go out and get your certified financial planning designation, a CPA, anything out there that requires credentials, you got to take tests for, stuff like that. They now are allowing people to use that for that. Trump accounts. There's a great article, taxfoundation.org-blog, and you can see that here. Trump-accounts could be better. They could be better. There's some things about that. Bottom line is you're having a child in 2025, 26, 27, 28. They're going to give you $1,000. And we haven't seen yet whether it's going to be a credit on your return or they're going to deposit automatically into a qualified bank or financial institution. And then you, the parent, can also put $5,000 a year on top of that in there. And then also you have, if an employer can make a contribution up to $2,500, you make up the other part as well for $2,500. So this is another way, instead of a 529 account you can look at. There's going to get more details. We haven't gotten them all out. They're a little bit unclear as far as what you're going to be able to use them for. There's some things that have come out, obviously education, if you start your own business maybe. But there's going to be more guidance coming out on that as well. So we'll continue to monitor that. Charitable deductions. This is huge. So if you're thinking, if you're a non-itemizer, so you're taking normally that $25,000, $30,000 standard deduction for family or individual, say $15,000, $16,000, and you've been wanting to give to charity, but you can't take the standard or you can't take a deduction on it. Now they've changed this that you, as a single person, you can Add $1,000 on top of your normal standard deduction. It's above the line. That AGI can reduce that down up to $1,000, $2,000 for filing jointly. And there's not any kind of limitation as far as income. If you are an itemizer, so if you're itemizing deductions, you go above that 31,750 I was talking about, or I think it was 15,750. So just to go back real quick, if you're single, 15,750, or joint down here at 31,500, from a charitable standpoint, I'm pulling this back up so you can see it. If you're itemized and you go above that, then there is a small phase out where the first 0.5% of your income, you have to get above that to be able to make the deduction on top of it. So larger income people may be limited on this. As far as income below these normal standard deductions, if you're a standard deduction type person here or family, then 1,000 individual, 2,000 joint on top of your standard deduction. Before you couldn't do that, which is great. All right, so let's move on. This is also huge, which is not addressed. So if you are somebody under 65, not on Medicare, and you're a small business owner or whatever, and you're retiring early, let's say, 55, 60, how are you going to pay for insurance? Most people are using the government health care, Affordable Care Act. Go to healthcare.gov, and they're getting their health insurance coverage through there. Ever since 2017 and through COVID, it was actually extended, even made a little better as far as getting credits based on your income. They did not address that. And there is talk they're going to have to come up with another tax bill, a supplement by year end. Otherwise, all these credits that people have been getting will go away. And that means you could see massive increases to your actual health care costs in these scenarios. A lot of these insurance companies right now are requesting 15, 20, I've seen up to 50% in certain states requesting these increases on premiums to cover this because they're not going to be getting these credits and everything. And there's different, they look at the poverty level incomes, and I'll blow this up a little bit. All right, so normally what they do is they look at the federal poverty guidelines, all right, to determine, this is like how many people are in your household. So let's just say 4 people in a household, all right? If you fall anywhere typically up to 150% of the federal poverty line, so this case would be 46.8, and you got a family of 4, you're basically not paying anything for your health insurance going through healthcare.gov. But once you start creeping over that, you start giving a percentage of your income that you have to pay up to typically. Now you may not go all the way up to that, and they've made this maximum of 8.5%. So what they've done is, let's say for example, somebody making 100 grand, they put a maximum cap of your income that you would pay. Now you may not essentially pay that amount, but they say these plans can't go above that. Health insurance plans where your premiums can't be more than 8.5% of your adjusted gross income. That is also going away if they don't do anything. So this is a huge deal, guys. Pay attention to this. Good place to do that is the Kaiser Foundation, kff.org, I believe it is. Check that out. There's an actual article right here. You can pull that from as well on there. Medicaid supplemental nutrition assistant work requirements. This still is, everybody think this is going to affect this year. No, this isn't even going to happen until 2027. They still got to get all this out to everybody as far as letting everybody know there's a good amount of lead time for anybody that's on Medicaid getting benefits and how this is all going to work out. And there's a lot of qualifying exemptions out here. And I'm not going to go into all this right now because we have such kind of a lead time, but a couple quick ones. Right now, they're throwing out qualifying activities. You work 80 hours a month of work or community service and or work program participation, or enrolled in education at least half-time. Any combination above totaling 80 hours will qualify you still to get the Medicaid benefits. And then there's mandatory exemptions that are coming out on this. If you look at this, parent, guardian, caretakers of dependent children under age 13 or disabled, pregnant or receiving postpartum coverage, foster youth, former foster youth under age 26, medically frail, participating in the SUD program, meeting SNAP work requirements, American Indians and Alaska Natives, disabled veterans, incarcerated or released from incarceration with 90 days, entitled to Medicare Part A, and you're enrolled in that, also gets you exempted. And there's some hardship exemptions over here to the right as well. So there's a lot of actual exemptions and qualifications that can be met that can still get you earning these Medicaid benefits. So just keep a watch on that. Again, it's not going to happen. There's going to be more guidance on this throughout 26 and then eventually in 27 to implement it. But right now, it's not going to impact you on here. Health savings account, big update. Again, go to kff.org and get these updated and track them live. A couple big things there. Before, if you went on Medicare, you'd have to stop putting money into a health savings account. They're increasing the amount you can put in there. Now, the other big change is before, if you had a family, you had the main spouse putting in the max for the family in their account, say $8,550 or whatever it is. Then the spouse could also contribute their own $1,000, but they'd have to open up a whole separate account. That's gone away. So now they can actually put their same additional qualification money inside of that as well, that they're eligible for $1,000 if they're eligible. Another big one is opportunity zones. If you sell anything, crypto, and this is outside your IRA account, crypto, a house, a business, stock, whatever, and you got this massive capital gain, you can now take your money in this capital gain. You don't have to take the principal, take the capital gain and reinvest in what are called these opportunity zones. And this is where all the governors of the different states out there pick these areas they want to have developed. If you invest in these opportunity zones, you don't have to pay tax on that capital gain right away. It's deferred. And the other cool thing is that in these opportunity zones, if you hold it out for at least 10 years, any gain you get on that property, that development that goes on in there, completely tax-free. So if you've got some big gains in crypto or anything like this, call us. We have access to these and we can show you how these work in more detail. So I'm not going to go in. That's just the bottom line. Bonus depreciation. This is for business owners. Big, huge deal. 100% bonus depreciation is coming back. For example, if you went out and bought a truck over 6,000 pounds this year, 100% bonus depreciation, you write it all off in 1 year. Now, you may or may not want to do that. There's some tax planning ideas on there, but there's some big opportunities here again. Could get into real estate. If you're buying Airbnbs or some type of property or a self-rental for your business. Big deal here with bonus depreciation that we help our clients tax plan around, also with their CPAs and stuff. So big thing, be aware of that. The estate and gift tax exemption. This is permanent now. It's going to be $15 million per person, $30 million for couple. And if you got, now there's people still that have estates over these amounts. Includes your insurance, death benefit, your properties, a business, your investment accounts. A lot of people have made a lot of money here. If you happen to get an estate, again, this is a 1%ers, but over 30 million, you still have to do some estate planning. If you're above that, you pass away and you haven't done proper estate planning, about half of your estate goes to the government. And there's ways to get around that. So you'll need to call us if you have an estate at over 30 million. Even without that, there's estate planning you got to do. We can talk to you about that. 1099 reporting for businesses raises the threshold. This is when you're paying like a contractor or something like that. Normally, if it was over 600, you had to report this. Now it goes all the way up to 2,000 where you don't have to give a 1099. This is huge for business owners, C Corp, not an S corporation, but a C corporation. If you have owned a business and you've got this massive, a lot of this applies like tech, big things here recently over the past 5 years. If your business has grown so much and you sell it, you have the ability to exclude up to 75 million tax-free gain of selling your C Corp stock to somebody else. All right. This doesn't apply to public, the Apples and the Googles, if you're owning that, stuff like that. This applies to people who own the actual company. And you get, after 3 years, it's phased in now. This is completely different. 50% of it is excluded from tax. 4 years, 75, 5 years, 100%. And they raised the limit to 75 million that you can sell your business without paying any capital gain tax. So if you're somebody that's just starting out, starting a business, maybe you've been seeing a lot of things on YouTube. Oh, you got to get an S Corp, all this kind of stuff. Because of taking distributions versus salary, and you can lower your FICA tax and all that. You have to take a second look. If this could be a potential huge, fast-growing business you may want to sell, you may want to actually put a little brake on that S corporation and maybe take a look at a C corp and run the numbers. We have accountants in our network we can certainly get you in front of to do that kind of business valuations. There are actually attorneys that do business valuation, stuff like that. So hopefully that makes sense on that. There's some factory expensing. President Trump's trying to get companies that manufacture products back in the United States given a huge 4-year, 100% expensing benefit for construction of new factories, logistics demand, manufacturing space, and tax advantage development back here. I'm not going to go over all this, but that's a big thing. Clean energy. If you're looking to invest in any kind of solar or electric vehicles, start working on this before October 1st because it's going away on that situation. So anyway, appreciate you guys joining on. Hopefully you found this helpful. We've got some other videos that'll break these out even further, go into more depth, especially check out that one for senior deductions where we walk through the 1040 and example the new standard deductions or taking distributions from their IRA, getting interest payments, capital gains, and still pay zero income tax at the federal level. Thanks for watching. If you want to reach out, let us know. And here's a way you can contact us, by the way. And it's down in the description as well, but feel free to reach out to us. Text us at 513-657-0989. Email us, william.wilkins@lpl.com, or you can go to pursuefinancialfreedom.com and click on the Contact Us button, get a hold of us, and be glad to set up a consult with you and give you access to the #1 financial planning software in the country. Thanks for watching.
Too many days in the darkness without a glimpse of the light, running tired and broken and scared, but I swear I'll never give up the fight. I see you broken and beat